This is the Building Wealth Podcast with your host, Stephen P. Sitkowski.
Well, hello, everybody. Stephen Sitkowski here. Welcome to my Building Wealth podcast. We have got lots to talk about. I have some great news. I have some not so great news as to what's impacting the markets these days and what you might want to think about doing about it. And isn't that how it always is? Right? There's always combination of good stuff going on, not so good stuff. We call it life. But we're here to talk about it and to talk about what we might be able to do, given the circumstances of the day, to do better in our lives. So that's why I do this each week. Those of you who may not know me, there's just a little bit of my background. Been working with people and their money now for, gosh, 45 years. Long time. I've seen a few things. And what I try to do is take those experiences in working with others, the experiences I've had, obviously, managing my own money and building my own investment game plan, and sharing that with all of you. So I'm trying to nonchalantly grab something. I'm not sure if it's possible to do it nonchalantly. So let's get to it. I want you to know that everything that we do here is for educational purposes only. It is not intended as investment advice. So, what's moving the markets? Well, tensions in the Middle East are escalating. It's hard to know what to believe. So, what I've heard is, according to reports from the UAE, that they have been under attack by missiles from Iran. I've also heard or read that we have sank a couple of Iranian ships. The whole deal is we're trying to get the Strait of Hormuz open back up again, get oil prices down. But I got to tell you, from where I sit, from what I read, and I try to stay up on these things the best that you can. You just never know what somebody's feeding you, right? And everybody wants to give you intel that serves their purpose or their vision or their position. Things don't seem like they're getting better at all. We've gone from quote unquote, the war in Iran is complete. That was 6 weeks ago. What the hell did we complete? So oil prices, um, as you're about to see, still going up, which is inflationary across the board, which is impacting what the Fed's going to be able to do relative to interest rates. I mean, this stuff's all a big deal. Now, you want some good news? First quarter earnings look like they're going to come in with a 25% growth rate. Unheard of. So, if you want to know how the economy is functioning, I think it'd be fair to say when the economy is doing well, people are spending money, companies are profiting, and that's what's showing up. 25% earnings growth for the first quarter. Unbelievable. And the Russell 2000 this morning hit an all-time high. So the Russell is an index consisting of 2,000 small cap stocks. This is widely regarded as a proxy for the US economy. And the fact it's at an all-time high, I think, speaks volumes. 10-year Treasury is higher, 4.45%. This is getting close to being problematic because of the anticipation of oil prices being higher for longer. And again, the Fed having their hands tied. We're seeing Treasury rates creeping up. That's bad for mortgages. It's bad for consumers who have debt. And if this goes above 4.5, I think it's going to have a negative impact on equities. If it goes above 5%, I think you can expect to see the market fall 10%. I think that's a reasonable expectation. So I look at the yield on the 10-year every day, and oil prices have jumped back up to 105.55 per barrel. If you remember, right after the war broke out, oil took off, hit a high of $111 a barrel, pulled back into the low 80s. And everybody thought, okay, things are going to go back to normal. Well, we're a lot closer to the high than we are to the low. And none of that's going to change till they cut a deal. So, market breadth. This is kind of what's happening under the surface, below the headline, as it were. So, we have the New York Stock Exchange and we have the NASDAQ. So, the NASDAQ is going to be heavy on the tech side. So, there's two things I like to look at: number of advancers versus decliners. So, this was for last week. And then the number of new 52-week highs versus 52-week lows. Advancers, 1519 versus 1299. Pretty good. What's even better, 317 new highs versus 80 new lows. That's strong. On the NASDAQ, 2,717 advancers, 2,402 decliners, 651 new highs, 340 new lows. So, all of that, very positive. Might be why we have seen recent highs on the S&P, the NASDAQ, and as I mentioned, the Russell 2000. So, from last week, the winners are, well, the CBOE, that's the Chicago Board Options Exchange. People are trading options right now like crazy, including yours truly. That's up 9%. SanDisk has been ripping. It's at 1187 a share. Probably out of reach for the average person to run out and buy 100 shares, but it was up eight and a quarter. Seagate Technology, Oracle, Datadog, Intel, all really good moves. Last week's heat map. So the first thing that I focus in on, am I seeing more green or red? I'm seeing more green, not like by a huge margin. And then I look for the big movers. So semiconductors, that whole patch was down. I think that's some profit taking. Um, then I'm looking at Nvidia down almost 5%. Microsoft 2.5%. Microsoft announced earnings. Meta announced earnings down almost 10% for the week. Also announcing earnings, but a big winner, Alphabet, formerly known as Google. So up 12%. Caterpillar keeps rocking and a rolling. Caterpillar sort of transformed themselves into a quasi AI company because they're creating machinery that can operate without people using artificial intelligence. It's kind of tough for the operators. Um, Visa announced they had a good week, 6%. Eli Lilly, they're up 9%. So a lot of positive notes in the market last week. Speaking of positive notes, check this out. Future earnings outlook. So for the first quarter of 26, they've got 15%. That's going to have to be updated. Second quarter, 20%. Third quarter, 21%. Fourth quarter, 20%. These are some of the best earnings percentages that I've seen in my career. And I've been at this a lot of years. I mean, that's just spectacular. As earnings go, so goes the market. They call earnings the mother's milk of the stock market. I think it was Larry Kudlow, maybe, that coined that phrase. So, given the fact that we're not going to get any help from the Fed, right? We're not going to get any interest rate cuts. Um, the big catalyst in the market will be earnings and news about the Middle East. Those are the two things that we're counting on to drive this market higher. So there's always the question of, okay, so the market's made a really nice recovery. It bottomed out in October of 2022. And the market's up since then about 100%. So is it too expensive? Well, you need to have a historical perspective. If you look at bull markets going back to 1950, the average bull market is up 192%. We're up 100%. So maybe there's still room to run. I think that's a reasonable position. Kind of a high level look at a couple of things. On the left-hand side, you have the median S&P 500 stock distance below their 52-week average. So whatever sector we're talking about, the average stock, how far are they below their 52-week high? What's got legitimate room to the upside? Healthcare, 19%. So basically, they're in correction territory. Consumer discretionary had a big run up and then a pullback. Ditto for communication services. Staples, they got way ahead of their skis. I mean, some of the prices of these consumer staple stocks are just idiotic. There's just no value play in them at all. And that's supposed to where we're supposed to go during the tough times. What's trading near its high? Energy, big shocker. Right? The average energy stock is only 3% off of its 52-week high, which means lots of momentum. Same with utilities. And utilities are really being driven by the need for power to fuel these AI data centers. On the right-hand side, what we're looking at is US equity return since the start of the war in Iran. So semis are up 30%, tech's up 13%. So what's been hurt since the war's broken out? Healthcare, staples, materials. Forward-looking PEs. I'm going to blow this up for you because there's some things here I want to make sure that you can see. So SK Hynix, this is a $600 billion company. Their forward PE, so to give you some perspective, the forward PE on the S&P 500 right now is low 20s, 21, 22. This is at 4.3 with an earnings growth rate next year of 23%, which puts the PEG, the PEG or the PEG ratio, that's the PE ratio divided by the earnings growth rate. Anything below 2, I think, is considered really good value. It's at 0.18. That's insane. You can sort of scan the. I'm a big fan of Micron technology. It's made a big move higher, but it's still trading at a PE of 5.4, a forward PE, and they're expecting earnings growth next year of like 70%. So I can tell you, I own that. That's not an investment recommendation for the rest of you. Um, like Nvidia still has a ton of value. They have a forward PE of less than the S&P 500 with an earnings growth rate of 34%, which puts their PEG at 0.50. So you can look on here, and there's a bunch that I think have a whole lot to offer. in terms of value. So for sure, I wanted to share that with you. Market sentiment. So every week they do a little survey of the American Association of Independent Investors. And they ask them, where do you think the market's going to be over the next 6 months? And you can see that the sentiment has declined a bit. So 2 weeks ago, we're at 46% bullish. That's dropped down to 38%. And this is before all the negative news from the Middle East. In terms of bearishness, you can see that moved up from 34 to 39.7. Let's call it 40. So right now, there's slightly more bearishness anticipated for the next 6 months than bullishness. Now, that's from the independent investors. CNN does a survey, and I'm not sure specifically who they target, but this happens daily where they take the pulse of the investment community and they'll sort of gauge it anywhere from extreme fear to extreme greed, 0 to 100. And right now, we're in greed, which means investors are fairly optimistic. So, sort of conflicts with that other survey. Future of interest rates. So, like I said, the Fed, they have their hands tied. You've got oil at $105 a barrel. So many things are made with petroleum products. Almost everything has to get transported. That's going to raise costs. It's going to raise inflation. The latest core PCE came in at 3.2%. Fed's target is at 2%. Fed's not going to be able to do anything. Now we're going to get a new Fed chairman, Kevin Marsh, or Warsh, and he supposed to take that position May 15th, assuming all the approvals are in place. He is a Trump appointee. Trump wants interest rates lower. Lower interest rates stimulate the economy. I don't think he's going to be able to pull it off. I think Warsh is going to have to sit back and go, you know what? The threat of inflation is greater than the threat currently in the labor market. And that's really what they wrestle with. They have a dual mandate, stable pricing and full employment. Well, we basically have full employment. So he's not going to lower interest rates to accommodate employment when, the people that are struggling because of the higher prices across the board, they need the help more. So as of right now, we are not expecting a rate cut from the Fed until December of 2027. So this market's going to have to be driven by earnings and then ultimately some positive news out of Iran. Sector performance. So the S&P 500 of 5.59%. And then as you kind of scroll through, the big winner, obviously, energy, up 30%. Industrials and materials, they benefit from AI data center construction. Real estate, staples, utilities, beneficiaries of a flight to safety during times of uncertainty. And who's underperforming? Financials. I'm still waiting for them to make their move, and I believe that they will. And healthcare. I think there's some opportunities in healthcare. I think Pfizer, based on its current pricing and the fact that it's paying about a 6.5% dividend, I think that's a relatively low risk proposition right now. This week's earnings, what do I think can potentially move the market? I'm going to go with Palantir After the close of the bell today, AMD, after the close of the bell tomorrow, Shopify, you might get some insights as to the health of the consumer. Ditto with PayPal. Um, is there anything else that I really think is going to have a big influence on the market? Maybe McDonald's, as they talk about the consumer and their willingness to, eat out. So those are probably what's worth at least watching. News of the week, not a particularly busy news week. I'll tell you the things that I will be primarily interested in. Um, on Tuesday, we are going to get the JOLTS number. This is job openings. So um, it's supposed to come in at 6.8 million. So we'll watch that. We're going to get the S&P final U.S. Services PMI, Purchasing Managers Index. Is that going to move the market? Probably not. I don't think that that carries too much weight. Now, on Wednesday, we get the ADP employment number. How many jobs are we going to add? It's expected to come in close to 100,000. That would be for the month of April. On Thursday, initial jobless claims. We had a great surprise um, last week. We were forecasting initial jobless claims come in, I think, at 207,000, came in at 189,000. That was a pleasant surprise. And it's expected to be 205,000 for the announcement on Thursday. So I watch that every Thursday. And then on Friday, pretty big stuff. US employment report, the unemployment rate supposed to stay at 4.3%. That really hasn't budged in a long time. That's a very solid rate. The Fed has always considered anything under 5% to be full employment. And then it'll be interesting to see the consumer sentiment. How are people feeling? It's expected to look about like last month. So that'll be the news that I will definitely be keeping an eye on. If you're smart, you'll be keeping an eye on it as well. I'm pretty sure you're smart. You listen to this podcast, you got to have something going on. Let's take a look at the charts. So, the two things that I want to share with you, first of all, we always want to take a peek at the S&P 500. So we've had a pullback today of about a 0.5%, but overall the chart is in pretty good shape. 6 months ago, the S&P was at 6,800. Now it's at about 7,200. And given the headwinds that we've dealt with, the fact that the market's done that well, frankly, is remarkable to me. Now, if I look at an intraday, and I never know what day you're watching this podcast, but if I look at an intraday, I can sort of see where, the announcement was made about UAE, and market took a big move to the downside. It's tried to recover. It's struggling a little bit. But overall, you know, you have the 50-day moving average that's now sloping up once again, which is bullish, and we are significantly higher than the 50-day moving average. So both those are bullish. The other chart I want to look at is the VIX. We call it the fear index, also known as volatility index of the S&P 500. Basically, when the market comes down, this goes up. And today it is up about 8%, but it's not in a problematic area. The VIX will typically trade between 13 and 25. Right now we're at 1834, which is closer to 13 than 25. So, again, given what's going on out there, there's a pretty good sense of calm in the market. I think, and it could be false expectations, but people believe that we should get some resolution um, to the Iranian situation sooner rather than later. I thought it would have happened very candidly by now. So, how much longer this gets dragged out, I couldn't tell you. So, one of the things that my trading partner and I do every week is we come up with our trade ideas of the week. Typically, there's 2 to 4 trades that we put on. And then I'll pick one that we recently closed to share with all of you good folks. It's funny, I remember when I would teach classes decades ago, and I would use this hypothetical company where the stock symbol was XYZ. Now it really exists. It's formerly known as Block. So we did a call spread on this. And the way that a call spread works, you're simultaneously selling an option and buying an option. And the idea is the option you're selling helps to pay for the option that you're buying. So in this case, I think, let me look, I'll get you an exact number. We got into that for less than $1 a share. We got in at 80 cents a share. So you could have done a contract for $80, right? We were in and out of the trade in 10 days, made a profit of 22.5%. So we have really done well with this service for the last 3 years. So if you wanted to check it out, if you're an option trader and you're looking for trade ideas, this is about as good as it gets. And you can learn all about the service going to tradeideasoftheweek.com. Let me just show you what that looks like. Okay. So this is the site. And up here, welcome everybody. Steven Sitkowski here with my partner. So if you want to learn about the service, there's a little 8-minute video to watch. And if you want to see the track record, you would click here. So you can see for this year, we've been profitable on 100% of our closed trades. Average hold for those trades about 10 days. Average return's been 17% per trade, not for the year, for 10 days. I can promise you we will not finish the year at 100% win rate, but we've done pretty darn good last year on our trades. And you can see, I mean, there's lots of trades here. Average return was about 14%. Average hold was about a month. Win percentage about 97%. And the year before that, average profit around 16%. In 22 days, win rate 92%. So I don't know that there's anything out there that's, any better than that. So if you wanted to check that out, that'd be great. And something I have been threatening to do and haven't done, and I'll do something more formal for you at some point. But let me give you just a little introduction to the world of options. So if you're new to options, then I at least want you to have a basic understanding. And we can go deeper in other podcasts. I may devote an entire podcast. In fact, I'm sure I will, to just options. But just kind of for your edification at the moment, there's only 2 types of options. We have call options and we have put options. So think of a call option like a coupon. A call option gives the owner the right to buy a stock at a certain price for a certain period of time. So the value of a call option goes higher when the price of the underlying stock goes higher. So basically, when you buy a call option, you're betting that the price of that stock is going to go up in the near future. So it's a bullish trade. The other type of an option is known as a put option. A put option gives us the right to sell a stock. Think of a put option like insurance, right? You have the right to sell a stock at a certain price. The value of a put option goes up when the price of a stock goes down. So let me ask you a question. Would it be fair to say that over time, all stocks both go up and down? Of course they do. So when we're looking at a stock or an ETF, an index, and we believe in the near term it's likely to go higher, we would use a call option. If we think it's going to go lower, we would use a put option. So all stocks, given enough time, both go up and down, right? You're all aware of that. So this gives you a chance to sort of shift between calls and puts. Now let's contrast that to owning a stock. If you own a stock and it goes up, you're making money. When it goes down, you're losing money, right? What if you could make money both directions? You can. That's what's awesome about this. Um, when people ask me, where did my interest in options originate? I always point to four basic things. Number one, the idea of leverage. So, leverage means that a smaller amount of money can control a larger amount of money. Leverage also means that a small move in the price of a stock can generate a larger move in the value of the option. So, let me see if I can demonstrate this for you. So I'm just randomly going to pick something and I want to find a small move. And then we'll compare the profit potential between the stock and the option. Now I'm looking for, all right, there's a small move right here. So this is Palantir. Okay. So let's come back over here where Palantir crossed above its 50-day moving average and then topped out. So I'm going to make a couple of little notes here. Um, we can get rid of that little annotation. So on December 5th, Palantir closed, I'm going to go to the nearest dollar, 182. And on December 24th, so we're talking about 19 days later, it closed at 194. So if you owned the stock, you'd have made $12 a share. If you make $12 a share on a $182 stock, what is that, like 6 or 7%? Here, let me use an electric brain. 12 divided by 182, 6.5%, right between 6 and 7. All right, so that's if you bought the stock. What if you'd have bought a call option? I'm going to use this little backtest feature. I'm going to go back to December 5th. There we go. And I'm going to buy a call option. And let's see what the profit could have been. So if you own the stock, you made 6.5%, right? If we'd have bought the call option, profit would have been 56%, almost 10 times the return from the stock. So when I see a stock that I believe, based on the chart, is getting ready to make a move and do it right now, you make a lot more money, as you just saw, with a call option. People ask me all the time, well, when do you buy a stock versus when would you buy a call option? And the answer is, if I'm interested in the stock because of its fundamentals, meaning the numbers on the business and their longer term prospects, I want to own the stock. On the other hand, if I'm interested in the stock because I'm looking at it on a chart and I think it's going to move and move quickly, oh, you make way more money with a call option. So there's not one better than another. It's all circumstantial, which is why obviously getting educated on this topic is pretty important. Hedging. So, how to use an option to hedge? Well, let me give you an example. Say that you own a stock trading for $100 per share. Okay. So if you have a $100 stock, what is your risk? $100 a share. What could you do to mitigate that risk? Let's say we bought a 95 strike put option. So there's your insurance. If that $100 stock went to zero, you could cash in the put, get $95 a share. So you just eliminated 95% of the risk of owning that particular stock. One of the things that I always find sort of interesting are the number of people that'll say, well, I've heard you should stay away from options because they're too risky. So I just gave you an example of using an option. Did I increase my risk or did I reduce my risk? I reduced my risk by 95%. By the way, if options were so risky, why did Warren Buffett use them? Why do I use them? Why do hedge funds use them? Family offices, Wall Street firms, investment banks, we're all using options, right? The reason that you hear they're too risky is because the average person will try to trade options without really knowing what they're doing. And then they go out and lose money. And when they lose money, they don't want to blame themselves. No, it's easier to blame options, right? Next, big profit potential. As you just saw, it is not uncommon to see an option trade that'll produce a profit in excess of 100%. I remember I did a call option on Exxon some time back, and the profit on that trade ended up 703%. So when you get into an option trade, if that underlying stock starts to run, you can make a whole lot of money. And you have limited risk with an option. When you buy an option, the most money you can lose is whatever you paid for the option. But you have a chance to make more than what you paid. So, you want to know why I trade options? Those are the four reasons. So, tell you what I'm going to do. By the way, thank you for listening and staying to the end. I would love to know what other topics you'd like for me to cover, and or questions that you may have. So let me throw out my email address for you. My email is just my name, Steve Sitkowski at gmail.com. So it's Steve, S like Sam, IT like Tom, Kowski at gmail.com. So if there's some subject you'd like for me to hit on, or a particular question that you've got, part of my game plan and in doing these podcasts is to make them more and more interactive. So there you go. Hit me up and I'll try to include it in the next broadcast. So great being with you again. Thank you so much for taking the time. And I will be back with you next week. So until then, be safe, be blessed, and bye for now.